Hello, everyone, and welcome to today's webinar on market insights for fixed income, where we will explore the key trends and opportunities shaping the fixed income landscape. I am Sandeep Solanki, product specialist, and I am joined by Mr. Anurag Mittal, who is head of our fixed income, who will walk us through the latest market developments and provide valuable insights on the current state of the fixed income market. After Anurag's update, we will open the session for Q&A segment. You are welcome to submit your question throughout the webinar via the link provided. Let's dive into the today's session. Anurag, over to you.
Good day, everyone, and I hope you found the previous webinar useful, and thanks for dialing into this one as well. Without taking further time, I'll straight away dive into key global trends. Then we'll discuss the domestic considerations as well, which are shaping the fixed income market, including the recent RBI policy and what product strategies make sense in this environment. So broadly, since the tariffs have been levied since 2nd of April, which was the Liberation Day, economists, market commentators, various portfolio managers, and even business, analysts have been waiting that probably all the economic uncertainty, the tariffs, the trade negotiations, at some point of time may lead to inflationary pressure, they may lead to contraction in global trade, and also may lead to slowdown in economic activity. Just like last 2 3 years when the rate hikes were happening, starting from the Fed, there was also expectation that rate hikes probably at some point could lead to hard landing. But the this economic expansion continues to surprise everyone. So as you can see, both manufacturing as well as the services continue to do well across the world. In fact, we saw some slowdown in between, probably a couple of months in manufacturing because of some importers were still running down their inventory. But if you look at various, whether it's new export orders, whether you look at sales activity, it is going on quite strong. So far, we are yet to see negative impact of tariffs on pricing and hence economic activity as well. Even if you look at services, while there is a slight dip over the previous month, but if you look at the last 6 to 12 months, services also have been in an expansion. And if you look at on the chart on the right-hand side, which depicts the economic activity surprise index. So mind you, an upward sloping line is basically economic activity surprising better than the consensus expectations, and downward sloping is which is surprising negative to the expectation. So if you look at US, for example, after showing a slight dip in May and June 25, which was just after the imposition of tariffs, now economic activity continues to do quite well. The fiscal deficit or the fiscal stimulus in the US is still continuing. So broadly, whether we look at consumer spending, we look at labor market, we look at whether corporate results, all are right now painting toward an expansionary story. So broadly, this is quite important from a central bank perspective because if the economy is still doing quite well, it does not leave too much of I would say, room for a central bank to cut rates unless and until they see a decline in economic activity. And we'll talk about that, of course, in our next slide. So we also had the FOMC policy on 18 September, and as expected, FOMC cut rates by 25 basis, setting the Fed fund rates in the corridor of 4% to 4 quarter. The vote was 11-1, with the newly appointed governor Stephen Miran, who was earlier the economic advisor to President Trump, voting for a 50 basis rate cut. But the rest of the FOMC members who have been existing on the Federal Reserve Board are still looking at a 25 basis rate cut. The most notable statement came from Fed Chair Jerome Powell in the press conference when he said that the downside risk to employment or the labor market have increased. So while They mentioned that the Fed is attentive to both the risk on inflation and on labor market, but increasingly the downside risk on labor market, uh, are prevailing for them for now, which broadly means that while yes, inflation continues to be higher than their 2% target, but what they believe right now is that the unemployment rate at which US is right now 4.4%, if that continues and in fact it were to climb up, probably it could result in a much sharper slowdown and sharper risk to US growth. And that is why they cut the rate by 25 basis in this policy. uh, Fed characterized the rate cut as an insurance cut. So while what we mean by insurance cut is basically while the current data does not support a rate cut, but broadly it means that uh, since the policy is always looked at from a forward-looking perspective, the Fed wanted to ensure that the financial conditions ease at the margin to ensure support to growth outlook going forward as well. More than the current rate cut, which was largely priced in by the market, what really is quite surprising and quite interesting is the dot plot that you see on the right hand side of the chart. So broadly, the dot plots represent collection of the Fed members, how they see the economy going ahead and how they see interest rates going ahead. So if you look at the dot plots, they basically signify two more rate cuts in 2025. So we have one FOMC meeting on 28th of October and another in December. So probably 25 basis rate cuts that the Fed members are looking as of now in October and December, and one more cut in 2026. And if you compare this to market expectations, if you look at interest rate swaps, the swap market, at least that day, was pricing in about 120 basis of rate cuts. So compared to the Fed members who were seeing 75 basis of rate cuts, the bond market is looking at about 125 basis rate cuts. So there are two interesting observations, probably why the market is looking at more rate cuts than what the current Fed members are. So of course, in February, we know that the term for Fed Chair Jerome Powell matures, and probably there will be a new Fed chair, from March onwards, and that Fed chair probably could be more dovish than the current, interest rate trajectory that the current Fed dispensation is looking at. That is one. Secondly, again, the bond market is also expecting that the economic uncertainty created by tariffs and ongoing trade deals may result in higher job losses going forward. Even the advent of AI and the high use of AI in various business practices may also result in job losses going ahead, which may lead Federal Reserve to cut rates more aggressively than the current Fed members are right now thinking. If you look at again on the left hand side of the slide, the orange line, the US CPI, it still looks on the higher side, still around 3%, which is higher than the Fed's target of 2%. But if you look at the blue line, which reflects the addition to the US non-farm payrolls, that is showing a consistent decline. And that is what the market is looking at. So the market is looking at probably the decline in non-farm payrolls will become so acute in next 6 months, and the inflation considerations for the Fed will reduce meaningfully, and Fed will be much more strongly looking at the growth outlook and to ensure how to support for further growth going ahead. So broadly, it's a trade-off between sticky inflation and outlook on employment. Right now, the Fed thinks that while labor market will slow down, but it will not be something which will uh, lead to very aggressive rate cuts, or probably it will not be very alarming. Whereas the bond market thinks that at some point of time, the slowdown in labor market will be significant enough for Fed to warrant much higher rate cuts. So that's a trade-off we'll continue to see. and probably next 3 to 4 months, economic data will be very important. Both market and Fed will continue to be data dependent and continue to assess trends, and based on that only uh, further interest rate, trajectory would evolve. So, in a nutshell, market will remain volatile. So, markets are always volatile, of course, but probably given the push and pull of inflation and the labor market that the US is experiencing, we may see higher volatility in the US market, uh, especially the bond market that we are used to. So I talked about the importance of economic data in next 3 4 months and probably higher volatility. And ironically, we also saw one more very volatile event. The U.S. government went into shutdown on 1st of October, which has resulted in temporary suspension of some of the U.S. government services. So while you know most of our readers probably would not have seen a shutdown of the government in any of our sphere of work. But for the US, it has been quite a regular feature. So if you look at the right-hand side table on the slide, it reflects the various government shutdowns which have been happening with quite regularity since 1977. So interestingly, in the US, uh, the appropriations bill or the budget in a way has to pass through both the houses, the Senate, and the Congress. Right now, um, Republicans control both Senate and Congress, but in the upper house, that is the Senate, they are falling short of 60 votes to pass the appropriations bill. And the bone of contention between the Republicans and the Democrats in the US is towards healthcare. So like I said, they have to pass the budget or the appropriations bill in the US, and the appropriation bill talks about cutting healthcare subsidies. It also talks about cutting some tax benefits on healthcare insurance, which right now makes it uh, affordable for, especially for lower income groups. So, Democrats are against it because they want healthcare benefits to continue, whereas Republicans are quite sure that they want to remove the benefits for now because uh, as per them, the sources of those benefits, are questionable for now. And so that's the standoff right now until we see some, resolution on that front. Probably the government will remain under shutdown. If you look at the longest period of shutdown, that was apparently also under President Trump. So as you can see, the shutdown, which lasted from 21st of December 2018 to 25th of January 19, which was 34 days, was also under President Trump. And what does this shutdown mean? About 40% of federal workforce, or yeah, in the Indian context, the central government workforce, so about 750,000 employees will be put on unpaid leave. Uh, of course, the impact on labor market as of now should be moderate because they receive back pay once they rejoin the workforce. So the impact will not be um, should not be material. The only flip side is the president has threatened that they are likely to fire a lot of government workers in next couple of weeks for the services which they deem as unnecessary. So if those firing of workers become more permanent, probably there will be some impact on the labor market on more structural basis. Uh, Secondly, if we look at previous shutdowns, while the shutdown, reduces the GDP on an annualized basis by 0.1% every week of the shutdown, typically that comes back when the shutdown ends. So whatever the impact of the shutdown on the current, economic activities there, because all the employees receive back pay and all the contracts are awarded once the shutdown ends. Overall, uh, that reduction in economic activity is compensated at the later stages, but probably the GDP data could be noisy for next couple of months. The only problem which the Federal Reserve might face in the 28th October meeting, if the shutdown is not resolved by then, probably US will not be able to release their NFP data, uh, because of which then it may be difficult for the Fed to base their decision on the strength of the labor market, failing which they will be looking at the private data much more closely. So this is what we believe, that probably Fed will have to rely more on private economic data in case the economic forecasts are not published on time, in case the shutdown continues for a longer period of time. So that's something which we'll have to see, and that's something which Fed has already faced that situations in the past, and they have been able to manage their policy quite effectively. So we don't think for now it will be a problem, but yeah, it these issues will continue to be a source of the volatility in the upcoming days as well. So going on the commodity prices for now, because that of course impacts the inflationary outlook. So on the left hand side of the slide, we can see the Bloomberg Commodity Index, which reflects various commodity prices like precious metals, oil based metals, etc. And as we are able to see, the commodity index continues to remain well supported, especially driven by precious metals like gold, silver. The reason, like we discussed on the previous slides, one, the economic activity continues to remain quite expansionary. On the other hand, now market participants are expecting more aggressive rate cuts from the Fed, especially in a period of high inflation. So, typically when we are still seeing inflation higher than central bank target, but yet we see central banks cutting rates, typically market participants tend to gravitate towards precious metals such as gold and silver, and that's what's been happening for quite some time now. And in fact, from last month, we are also seeing some pullback in base metals as well. So for last 2 3 years, as we know, base metals were doing quite weakly because uh, Chinese economy was undergoing slowdown. Now the Chinese economy is stabilizing. The tariff war, in fact, has been quite favorable for China, because earlier the fears that market participants had that probably China will be slapped with much higher tariffs like 50% or 60% have been quite unfounded. And China, in fact, the gap between China and other Asian economies tariffs is very, very narrow, very moderate, and very manageable for China. So that's why China's economy is also stabilizing, and that's why we are seeing now, uh, base metal like aluminium, copper, iron ore, and steel also doing quite well. Whereas if you compare the food prices, this to the right hand side, reflects the FAO food price index. While it's on a YOY basis, it's up, but if you look at a month-on-month trend, it continues to trend down on weaker cereal and dairy prices, thanks to favorable monsoon and favorable weather across the world. We are seeing very good production, whether we look at wheat or whether we look at rice, or whether we look at dairy components as well. So that's also doing quite well, and hence we are seeing stabilization in food prices, which is very, very positive for India, because about 45% of our inflation basket comes from food. So as long as global food prices remain stable, this development is quite positive for India's inflationary outlook as well. Broadly on the how sovereign bond yields have moved across the world, as we can see, so what we are broadly seeing is a reversal of July move for the advanced economy. So if you look at this table closely, what we saw during July was most of the bond yields compared to June went up for the US, or it's what was UK or the Germany, um, on concerns of higher inflation, and probably Fed will not be in a position to cut. But as markets started to realize that Fed uh, will be cutting in September based on slightly weaker job market, and probably they can have a much more aggressive view of further Fed cuts, we started to see some rally in the Latin American and advanced economy bond market. If you contrast it to Asia, uh, Asia, because now the focus is that some of these economies will have to spend more on fiscal to support their affected economies because of the tariff wars. uh, Bond yields in most of these economies continue to go up. The biggest example is, of course, Japan, where they have been quite affected by the trade war, and market participants are expecting, the government to spend aggressively, and that's why we are seeing bond yields rising in Japan. Similar story we are seeing across Asia, whether you look at South Korea, whether you look at India. Broadly, the similar story is playing out across Asia. Uh, this, this is the US Financial Conditions Index, which reflects how credit spreads are evolving, how equity market valuations are doing, how bond yields are doing. And as we can see, the Financial Conditions Index remains quite healthy, which reflects market participants' comfort from the Fed. If you look at, in fact, US equity markets, they are doing quite well. If you look at US credit markets, that's also doing quite phenomenally. So overall financial conditions continue to be quite loose. And this is the swap curve, which on the right hand side. And as you can see, market participants are expecting aggressive rate cuts in the next 12 months. Now coming to India, so the most important event which happened in October for India was the RBI monetary policy. So there was a very mixed set of expectations, coming on the back of the RBI policy. Given the impact or the expected impact on India's growth due to the external tariff related issues, there was a section of market participants uh, who were expecting RBI to do a preemptive 25 basis rate cut. But what we have also seen during the previous month was uh, government announcing GST related measures where they rationalized, GST rates just to two slabs, which is almost equivalent of about 2 lakh crores, or about 0.7, 0.8% of GDP. And that's where we are seeing some growth stimulus also in a way given to consumers. So it was a kind of a mixed, you know, I would say outlook to the policy. But RBI did was RBI conducted itself in a very balanced manner where they kept the policy rate unchanged at 5.5%, and they retained the monetary policy stance as neutral. But the forward guidance given by RBI was quite cognizant of the growth headwinds that India continues to face, especially from the external sector. So the governors emphasized that the policy space for further supporting growth has opened up, which broadly means that RBI is open to interest rate cuts going ahead if the current macro conditions continue to evolve in a similar fashion. Why it is important is if you compare it to the previous August policy, the governor had emphasized that the policy room to cut rates was very limited. The reason that the RBI gave was if you look at the table of CPI inflation estimates, earlier RBI was forecasting a 4.9% inflation in the first quarter of FY27, that is between April to June. And given that, again, monetary policy is forward looking at a 5.5% repo rate and a 4.9% inflation, it was very difficult for RBI probably to justify further rate cuts. But what's many things have happened since then, like we discussed. The GST cuts have happened. The disinflationary momentum that the Indian economy is facing has continued. And if you look at the revised inflation estimates, now RBI is only estimating 2.6% inflation in FY26 on an average compared to 3.1. So there's a 50 basis decline. If you look at FY27 first quarter inflation projection as well, now RBI is projecting 4.5% compared to the 4.9% which it was expecting earlier. The second thing which RBI tried to really point out to the market is that the even the journey towards 4.5% inflation is because of the base effect. So if you look at uh, the current inflation, for example, especially in the first half, it's almost around 2%. So when you have such a low base, it's natural that the next year inflation at the similar time will be slightly on the higher side, even if there is no major inflationary trend. So what that means is if the growth outlook is slightly unfavorable and inflation, although on a headline level is about 4.5%, but the momentum is moderate, RBI may still be able to cut rates. So while we still don't think that a rate cut is a done deal in the next policy, if you look at the growth projections on the other hand, which is on the right hand side chart, RBI has also revised the growth estimates higher from 6.5 to 6.8% for FY26, although they have revised the FY27 first quarter growth projection downwards from 6.7 to 6.4. But if the RBI believes by the next policy that probably the trade deal is not working as intended, and there are further growth headwinds which are coming towards India, whether in terms of any tariff on services or any further issues on work visas, probably RBI will use this policy room to cut rates. So rather than cutting rates right now, because even the impact of previous rate cuts is still working through the system, the government has just done the GST rate cut. Probably RBI wanted to fully assess the impact of these measures on the economy. RBI also wants to see whether any trade negotiations happen before the next monetary policy, and if let's say there is not too much of a positive development from the trade related negotiations, especially with the US, probably RBI will use this policy space to cut rates in December. So overall, a positive policy from a bond market perspective. But more than the monetary policy, it was the regulatory actions which were very very constructive, and we believe more than the 25 or even a 50 basis rate cut, these regulatory actions should help drive credit growth for the banking system. So, for example, if so, right now RBI banks were working on a expected capital loss framework which was supposed to be implemented from 2027. So RBI has given a 4-year glide path to banks so that they can, rather than taking a higher provision just in one time and slow down their credit growth, RBI now has given them 4 years, which will allow banks to one recognize provisions in a more calibrated way and will help them to continue their growth and their lending to the real and productive sectors of the economy. Secondly, if you look at risk weights under Basel III norms, RBI has also reduced capital charge or risk weights to sectors like MSMEs and residential real estate. So which RBI sees as a priority area, which the government sees as a priority area. So banks will be able to lend to these sectors at a much lower risk weights. What that means is the lending cost uh, uh, for the banks to these sectors will come down, which should result in benefit to the borrowers as well. Also, there was an earlier draft guideline released in October 24, which had proposed regulatory restrictions on banks and to continue the same business as the group entity. So many of the banks right now run as a conglomerate. So they may have a housing finance entity to do housing loans, or they may have a gold loan entity, or they may have an NBFC doing capital market lending. So they may offer a bouquet of services to the same promoter or the same borrower. Some services may be undertaken by the bank, and some services may be affiliated, may be taken by the NBFC arm. So the earlier RBI dispensation was slightly circumspect on these activities, and in fact, there were guidelines which have been drafted, which were calling for the overlap activities to be shut down, and banks and their NBFC arm to operate as independent entities rather than a conglomerate. So the RBI, the governor, they rightly said that as situations change, banks also or the regulators also need to evolve. So, understanding the situation, understanding the needs of the borrower, now RBI has removed the regulatory restriction for banks and NBFCs or their subsidiaries to do overlap activities. Secondly, earlier banks were not allowed to finance capital, through capital market through acquisitions. Now banks have also been enabled to do that. So as we know, there's a lot of activity happening under IBC. Uh, the allowance to banks to fund acquisitions should speed up the process and help the banking system recover their dues also, faster. Again, one more measure which RBI has given is enhancing credit supply for large borrowers through the banking channel. So earlier there was a restriction on the ability of banks to lend directly as a loan to large borrowers. Now RBI has removed that. That means that banks can lend to the same borrower in a much larger quantum rather than just looking at them through capital markets only. Second, even under IPO funding, earlier the cap was 20 lakh rupees, which now they have increased to 1 crore rupees. And for listed debt securities, the cap has been removed altogether. So overall, a very, very positive regulatory actions for the banking sector as a whole, which should remove the cost of borrowing for the banks and which should result in some pass-through of these lower, borrowing cost to the borrowers as well. On the trade side, what we saw in July, the pickup in exports as many exporters front-loaded the expected increase in tariffs. Those exports slowed down in August, as we can see, especially non-oil exports fell from 32.9 billion to 30.6 billion. Uh, there was a benefit to the trade deficit, which of course we saw, if you look at the oil imports, they have also slowed down from 15.6 to 13.3. But if you look at the gold imports, so broadly the benefit that we got in lower oil imports or uh, that was partially offset by rising gold imports ahead of the festival season. So probably a mixed bag there. But there have been a lot of concerns since the higher fees announced for the H1B visa. Just to clarify, those probably will be more effective towards FY27 because the current H1B visa issue which have been issued, there will not be any fees levied on those visas. So probably this will impact on FY27 rather than FY26, which is very critical for our service exports. So if you continue to see our service exports, they continue to do quite well. So if you look at our service exports, they were in 16.2 billion in June 25, 16.4 in July, and in August we saw 16.6. So a continuous upward sloping improvement in our service exports, which we probably think will continue. So our high service exports will continue to offset our trade deficits on the merchandise side. But one of the key concerns of the market has been the underperformance of rupee. So if you look at rupee, that has been one of the worst performing currency in Asia since the beginning of this year. And this is despite a more than 10% depreciation in dollar. So despite a 10% depreciation in dollar, rupee has still continued to weaken against dollar. Uh, but but we think that probably it's a well thought out decision by the central bank not to intervene very aggressively in the INR market because when we are facing higher tariffs from the US, a better way to adjust for those tariffs is to let the currency depreciate and let our exports become more competitive. If you look at even RBI's forward book, RBI has been letting its forward book mature, which in a way also put some pressure on the currency. So if you look at from March, where RBI's forward book was about $85 billion, it has fallen to about $58 billion, so about $17 billion reduction in RBI's forward book, which shows RBI's confidence in our FX reserves, as well as their preference to let currency depreciate, moderately to ensure, more export competitiveness for Indian goods. On the fiscal side, again, there was a concern, because the lower nominal GDP how the tax collections will really pan out. And as you can see, tax collections have been slowing down. If you look at corporate tax collection, they are up just 2%, whereas if you look at income tax collections, they are down by 2.5% FITT to August. One change, of course, is this year the last date to submit income tax returns was extended till September. So probably we should see more tax collections coming out on the income tax side in October. So probably that's an anomaly this year, but that should get corrected. But nevertheless, the trend rate of growth is quite weak for this year so far. Only GST has been the only positive development where GST is still growing at 5%, but broadly tax revenues are moderating. Uh, if so, broadly, one of the good ways to see is your FY25. So FY25, when nominal GDP had grown by 9.7%, our tax collections had grown by 9.5%. So broadly, a tax buoyancy of one. This year, what we are seeing is nominal GDP is probably growing at 9%, and if we look at the tax buoyancy of one, that just kind of puts out a tax collection growth at about 9%. The government has budgeted about 10.5% tax collection growth. So probably we'll see some fiscal pressure at the year end. The government may have to respond to that fiscal pressure by cutting in some non-essential spending. If you look at even on the capex side, while the capex growth looks great at 43% for 5 months, out of that capex, about 50,000 crores is actually allocation to FCI, which will be repaid at some point of time. So it's not really a capex growth, it's just to let FCI continue with their procurement. So probably the capex growth is also not going as strong, and the government may have some room to reduce capex to ensure that they meet their fiscal consolidation roadmap. On the borrowing calendar, so the borrowing calendar was released on end of September. Uh, and what one of the key concerns of the bond market before the release of the borrowing calendar was that because of the various GST cuts and other measures that the government was announcing to reduce pressure on our exporters, the government may end up borrowing higher. They may announce higher fiscal deficit. But if you can look at the overall borrowing calendar, it has been quite manageable. In fact, it's marginally lower than the budget estimates of 14.8 trillion, which has been the feature of this government where they have continued to consolidate fiscal very sharply and very robustly from the post-COVID high of 9.2%. So the fiscal consolidation continues to hold, which is very positive for the bond market. The other feature of the borrowing calendar was the reduction in issuance of longer end. So one of the feedback which had gone to the government or RBI was to reduce longer end duration because as we know in the recent history, the government had been increasing longer end shares. So for example, if you can look at this table, from a share of 30% of more than 15-year maturity in FY23, the issuance went all the way to 52% of the total issuance by H2 FY25. So there was a very sharp increase in the central government issuance of longer end papers. And at the same time, even the state governments were issuing much more longer dated securities. So what that meant for the bond market was the duration supply was getting quite unmanageable, and we were seeing spread widening between the 10-year and the 30-year securities. So as now the government took the feedback, and if we can see, the share of 40-year GSEC has been reduced from 15.9 to 11.1. The share of 30-year has also been reduced, and similarly the 50-year. And all that reduction has been now loaded back into the 5, 10, and the 15-year side. So while the spread between 10 to 30 will reduce, probably the spread between overnight to 5-year or 5-year to 10-year may widen because of higher issuance on the 5 and 10-year distribution. So of course, what it means for the yield curve is probably in the near term, the spreads will remain tight, the curve will have a flattening bias, but ultimately the long-term performance will still depend on how SDL calendar distribution plays out, how fiscal consolidation plays out, especially for the next year when the government also has to announce a pay commission, which will again be a significant impact on government budget. So it's not just about this year, it's also about next year, and that's what something which we'll be keenly watching. Coming to the SDL calendar, broadly, SDL calendar came lower than expected at 2.8 trillion because the government advanced, a tax devolution of around 1 trillion on 1st of October to ensure that the states are able to wrap up their spending. So while it is higher still than Q3 FY25, but sequentially quite lower than 2.3 trillion in Q2 FY26. So we do expect the flattening trend to continue because the long end borrowing at the state level was also quite high. So the lower issuance at the state level probably bodes well for the long end of the yield curve for this month. But again, we'll have to see from next month how states continue their issuance. So mind you, there is many times there is a significant gap between the calendar announcement and the actual issuance. So the actual issuance starts to trend higher and towards longer end securities. Probably we will see steepening once again on the yield curve. On the T-bill borrowing calendar, broadly similar lines to last year. So as you can see, last year on the Q3, in FY25, the net T-bill issuance was negative 31,000 compared to this year, which is negative 22,000. And so this is a trend that we have been seeing because as the government cash position continues to be quite strong, the government tends to borrow less in T-bill in the first 3 quarters and tends to borrow higher because as they ramp up their spending in the fourth quarter, that is when the T-bill issuance picks up. So we expect a similar trend in the fourth quarter next year as well. On the credit growth, as we have been seeing for the last couple of months, the credit growth continues to be muted, especially due to lower retail growth as well. So the retail segment continues to remain slow. Of course, the measures that RBI has announced, whether on acquisition-related funding, IPO funding, lower risk weights for MSME and real estate on the residential side, that should help in pick up in credit growth after this festival season. Like I discussed, in one of the previous slides, because of the redistribution of maturity towards the 10-year and the 5-year, we saw this particular month, the long end outperforming the belly of the curve. So as you can see on the 1 month change, whereas the 30-year and the 40-year and the 15-year was down between 10 to 15 basis points. The 10-year was largely flat, and if you can see, the 8-9 year was just down by 1 to 6 basis. So broadly, long end performed. They may continue to perform in next couple of months, but broadly, the long-term trend of steepening bias, we believe, still continues to remain intact. These are largely the trends, the credit spread trends across the various tenors. So as we are seeing some spread compression in AA, so as interest rate becomes lower for longer, market participants are gravitating towards spread compression on the credit side. Probably that trend will continue as liquidity remains high and rates, even if they don't see major rate cuts, probably we'll see these rates much lower for longer, and this kind of environment, typically credit spreads tend to narrow down. So broadly on the outlook, like we said, like we discussed, liquidity should continue to remain easy. The central bank has committed that they will provide liquidity at a surplus 1% of NDTL, which means 2 to 2.5 lakh crores of surplus liquidity for the foreseeable future. If we look at inflation because of GST related cuts or whether for global issues continues to be quite manageable. At the same time, because of the external headwinds to growth, now RBI may be in a position to cut policy rates. But whether RBI cut rates or not, one thing is for sure that probably rates will remain much lower for longer, and hence it is quite constructive for the short to medium end of the yield curve. which will provide attractive accrual as well as roll down opportunities. So for investors who are looking at 6 to 12 month investment horizon, probably they can increase their duration and they can look at money market or low duration. Investors who are looking at more than 12-month investment horizon, they can consider products like short-term or corporate bond. And of course, if an investor has a more than 2 year investment horizon, they can consider income plus arbitrage funds for more tax efficient returns. And I will stop it for now, and will open the floor for question and answer. Thanks everyone for listening in. Sandeep, you are on mute.
I'm mute. Am I audible?
Yes.
Okay. Thank you, Anurag, for sharing the insights. Now we'll quickly jump to the Q&A session. So the first question is, despite the RBI maintaining a neutral stance, two monetary policy committee members have advocated a return to an accommodative tone. Do you think this divergence signals an internal policy recalibration ahead, or is it simply a tactical acknowledgement of disinflationary trends?
So I think that the monetary policy stance has been interpreted differently by different RBI dispensations. So at one point of time, RBI used to look monetary policy stance as a yardstick for liquidity. That means when they are in a withdrawal of accommodation stance, so liquidity should be tight. When they are in an accommodative stance, liquidity should be neutral or sorry, slightly positive. Right now, liquidity, like I said, the governor has already committed that they will likely to keep liquidity at a surplus of 1% of NDTL, which is in excess of 2 lakh crores. So we believe the stance from a liquidity perspective is already accommodated. Second point, the one of the again previous RBI dispensations, accommodative stance has been interpreted as that the next action will either be a rate cut or it will be a pause. But overall,
Uh,
RBI will be in a dovish outlook. What we are seeing from the RBI governor in their press conference, they already indicated that there is policy space to cut rates if the current macroeconomic situation continues to evolve in the expected lines. So probably RBI is already indicating that there is policy space to cut. So we think that from a actual policy vantage point, we are already accommodative from liquidity side. We are already accommodative that RBI is indicating that the rate cuts can happen. Probably, they did not change the stance to accommodative because they had just changed their stance from to neutral in the June policy. So probably it would have led to confusion where they just RBI changed the stance to just two policies back. If they would have again gone back to accommodative, probably it would have created confusion on the utility of stance in the market. But we think ultimately the stance doesn't matter for the bond market right now. What matters is what RBI is committing on liquidity, what RBI is committing on interest rates, and that is where RBI is quite sanguine, and that is where we think we should also be quite sanguine.
Okay, thank you. So the next question is, given the ongoing geopolitical tensions in Eastern Europe and Middle East, how do you foresee these development influencing risk premiums in the emerging market debt, including India?
So I think on the Middle East, there is already a ceasefire which was announced 2 days back. So there, I think both the governments have said that they are looking to honor that ceasefire. So I think Middle East probably we are seeing some stability. At some point of time, you know, uh, we should see much more normalization of trade in the Middle East as well. As far as the Eastern Europe, geopolitical escalation that you mentioned, see the tensions have been going since 2022, early February, right? It's not a recent phenomenon. So the bond market, the equity market, or the central banks are now have fully digested the impact of that developments. So we don't think there's any impact that we are seeing in the foreseeable future.
Okay. Uh, the government's recent borrowing pattern shows prudence, but with potential policy measures that could impact fiscal balances, example GST cuts and state level spending. How do you assess the government's ability to preserve the fiscal credibility while avoiding any crowding out effect of private credit demand?
So, ultimately, we think that the government will have to cut spending on some non-essential items, or they may even have to cut some of the capex related spending this year or even subsequent years going ahead as well. So if you look at the track record of the government, whether it was even COVID, the government followed a much more prudent path than many economists or what other countries were doing during similar times. So we think that probably the government should continue on the path of fiscal consolidation. Probably the roadmap will not be as aggressive as we would envisage, but I think they will still be on the path. And mind you, from next year, they are moving towards a debt to GDP framework rather than a fiscal deficit to GDP framework. So they will still continue to focus on the debt to GDP framework, which they have indicated in this year budget.
The new liquidity framework aims to keep overnight rates closer to the repo rate. Now, in practice, could this narrow the volatility at the short end, but inadvertently flatten the curve and reduce the carry opportunities going forward?
Uh, so the new liquidity framework is largely the same as previous liquidity framework because if you look at the previous liquidity framework, RBI had mentioned that the weighted average call rate will continue to be their operating rate. If you look at the new liquidity framework, they have still continued to target the weighted average call rate as their operating rate. So there is no change in the liquidity framework.
Okay, thank you. So the next question is spreads on state development loans are now above some corporate bonds, which is a rare inversion. Is so how do you see this? Is market underpricing corporate risk or overestimating the state level fiscal pressures?
I don't think it's about overestimating state level fiscal pressure or it's about underpricing corporate bond risk. So one has to appreciate when you talk about benchmark corporate bond levels, most of the benchmark corporate bonds are public financial institutions or public sector undertakings where there is an implied government support behind them and they are large public sector entities. So these are also, I would say, high quality papers. Secondly, on the SDL side, I think largely it's due to the very high issuance that we saw in Q2 of FY26. If the Q3 FY26 issuance is as per the calendar, probably we will see some compression in SDL spreads, but that's not an anomaly. That's been the trend for quite long because if you see the corporate bonds, they are well spread across maturities, and corporates are able to issue debt as per the investor preferences, and they are able to customize and they are able to also modulate their borrowing, whereas states have to issue in a certain quantum every month, and that's why state spreads in recent years have been above corporate bonds.
Okay. Uh, how are global commodity trends, particularly crude oil and industrial metals, shaping your inflation expectations for India in FY26 and 27?
So, commodities have been quite benign, especially the oil. So we don't expect oil to really lead to any inflationary pressure in India. If you look at food prices are also very well behaved. As far as the precious metals are concerned, yes, they do have a weightage in our core inflation, but uh, largely that's outside central bank's control. So whether RBI cuts rates or hikes rates, it really cannot influence gold and silver prices. Historically as well, RBI has looked through these one-off volatility, and we think that as long as the inflation is driven by these geopolitical or these specific commodity price pressures, RBI may not really include them in the consideration. And mind you, despite 50% appreciation in gold prices in last 1 year, inflation is still less than 2%.
Hmm. Thank you. In the interest of time, I will take one last question. What is your tactical view on short duration versus long duration funds over the next 2 to 3 years?
See, uh, there, I mean, I have a fundamental view, not really a technical view. On that fundamental view, we believe that, I mentioned earlier, that interest rates, especially given easy inflation and overall moderate growth, than what earlier the RBI was envisaging, we are likely to see these rates for a long period of time. So this is a very similar situation to what we saw during COVID, where after cutting rates initially, RBI kept those rates at a lower end for a couple of years, from 2020 to 2022. During these times, liquidity also remained easy, which is also a very similar situation what we are seeing right now. So you're seeing a very, very similar situation of easy liquidity and low rates. And during these times, when typically investors know that at some point of time, whether in next 6 months or 1 year or 2 years, interest rates will reverse, they tend to gravitate towards short to medium end of the yield curve. And that's what we are also expecting, that probably curves will continue to remain steep, and we continue to expect that the 1 to 3 year corporate bond or high quality corporate bonds to outperform in these times.
Okay. Thanks, Anurag, for answering all the questions and running us through the entire presentation and the detailed insights. So we'll conclude the discussion here. Thank you, participants, for joining us today. We hope Anurag's perspectives offered you valuable insights into the fixed income space and the road ahead. Wishing you a bright, joyful, and a prosperous Diwali season. We look forward to connecting you again soon. Thank you.
Thank you, everyone. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.